mixed to a weakish opening that we're seeing for most of the markets this time.
It's possible that the IT stocks will react positively. At least it's a sentiment positive on the sideline.
As of now, both Siemens and HDFC Bank are on Chris Foods' radar.
The Nifty is down about 21. It still amounts to only a 0.1% loss on the big boys.
Another 5 to 7% on the downside would give adequate margin of safety.
We expect that the industry will maintain the guided margins.
We are expecting the EBITDAs in the range of around 3,750 crores.
Carraro India is present in the sweet spot of agriculture and construction equipment.
The Nifty is almost at the 23,800 mark, staring at a minor cut of about 15 points.
You will see in coming days in terms of what kind of growth that companies is endeavored to companies going to achieve.
The last hour of trade, markets that were actually trading the green have given up all of the gains, and in fact they're selling the last 15 minutes to last half hour.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
That was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Lata Venkatesh. And Lata, it's a disappointing, session, right?
Yeah.
It showed so much promise. At one point of time, the Nifty conquered 23,900. And again, that onslaught of selling pressure at higher levels. The Nifty slipped close to about 1% from the day's high. The Nifty Bank is off 2.2% from the day's high. And look at the advance decline ratio, 1:3 now.
Yeah, it is looking bad. But to be fair, the early morning rally should have surprised us. Because we didn't start with very positive global cues anyway. FPIs are still selling, even if the trading is thinned. 1,300 crore of selling should not be taken lightly. That's the overnight tally we were working with. The bond yields were higher in the US. That always means more money is still being drawn by the mother market, the US market, and by the risk-free market, which is the US treasuries. So, and the dollar index, which was lower at, sub 108, we were at 107.98 thereabouts. And now that's climbed back to 108.06. So now there are all negative cues. Dollar index is up. The US curb deals, pre-market deals that that you get a whiff of how it will open, all those are down 0.25%. I mean, NASDAQ futures, Dow futures. And of course, Europe has opened with a sea of red. Not big cuts, but nothing is in the green. Yeah. So I don't think we could complain. And I have this cheeky feeling that funds and those with deep pockets will not waste their firepower today. They would like a better NAV finish. So why not use the little money you have tomorrow rather than today? So my fireworks are, or my expectation of fireworks is last half or tomorrow.
Well, if they are trading tomorrow, that is. But as you said, right, there's nothing in the green except a little bit of pharma stocks. So the Nifty Healthcare Index is the lone sector with a positive uptick of close to about 0.6%. But other than that, the heavy hitters, banks, the Nifty Bank is down 460 points. And from the day's high, the Nifty Bank, I repeat, is down 2.2%. IT is under pressure, metals is under pressure, auto is weak, real estate is weak. So everything is subdued and, seeing some amount of, elevated selling pressure. The Nifty once again is below the 200-day moving average of 23,860. The Nifty Bank is now trading below its 50 and 100-day moving average. We're at the day's low, and for the Nifty per se, getting back to it, we're pretty much close to the intraday low of last week, 23,647. So how should you position yourself in the last hour of trade? Rahul Sharma of JM Financial Services is with us on the show now with a few closing strategies. Rahul, is it just that there are very thin volumes and therefore you are seeing these big swings on either way? How would you read today's move in the market?
Yeah, so the texture of the market has been lackluster for most part of the week that gone by, and as far as the current positioning is set up, it is a range-bound market at the end of the day, with 23,540 odd as being the higher low that was formed on the 20th of December. So we believe that it's going to be a choppy market as of now. So 23,500 roundabout looks to be the lower side of the spectrum. And on the upside, I think the volatility just continues to surprise us on both the sides. So 24,100, 150 is where the resistance is placed for the Nifty. So broadly, this is the direction of the market. And at the same time, as long as the support level is not broken, I think there is a good chance that the recovery happens towards the latter half of this week. So positionally speaking, as of now, it's a very tight market of about 500, 600 points. Once we are out of it, I think then market will probably take direction from the first or second week of January when we have the earnings numbers coming up, and we have a lot more triggers for the market to get excited.
Rahul, what is the support? I'm sorry. Yeah. What is the support you said? 23,600 is the support?
Yeah, 23,540, which that is the low that was formed on the 20th of December. That continues to be the support for the market going into the next few trading sessions.
So till we're in the range, the Nifty is in a no trade zone in this 500-point range. And what about stocks?
Yeah, so it's best to be a day trader in this kind of a volatility. One sector which is clearly head and shoulders above the rest of the market is pharma. Pharma index has really taken off, and we believe that there is another 3 to 4% upside to be had at an index level, which means stocks could do very well, like 8 to 10% kind of moves. So pharma remains a favored pick as long as Nifty remains sideways. Once Nifty starts switching, coming out of the range, it could be banking and financial, which would come back into the momentum. So as of now, stocks like Aurobindo Pharma remains our top pick, looks good for a 5 to 6% kind of an upside from current levels, can be bought with a stop loss placed around the 1245 mark. And it's about the entire pack is doing well, but the rest of what seems to be the best placed in Aurobindo Pharma.
Oh, really? I thought you would say Biocon. Not for any reason, except that today it's one of the big gainers with volume, with decent volumes. It's up about 4%. No strategy there?
Yeah, so, just because it is up 4%, we've not really recommended it. But, in a couple of days back, our team has been bullish on this, and the stock has done fairly well. I think there is some more upside to be had in the same.
The biggest wealth creator in the pharma pack this year, at least, has been Wockhardt. Wockhardt is up more than 200%. It started the year with levels under 500 rupees, and it's ending at above 1,400 rupees. The 1 year will come up for you for Wockhardt. It's a gain of 240%.
Oh, absolutely, that's eye-popping. Well, as always, I mean, that's something we have said ad nauseum, hotel stocks.
Yeah.
I mean, I've been the toast of the year, and banking on that, look at Ventive Hospitality. That one also, besides the pharmaceutical IPO today, this one is also up 12%. I mean, that's a fairly good listing gain. And we'll come back to you with more stocks, Rahul. I do want to ask you about these e-commerce stocks. Zomato, Swiggy, Nykaa, all of them doing well today. But I'll come back to you on that. First, we want to hear about a little bit on the insurance space, because we have some breaking news from our reporter. Sources tell CNBC-TV18 that the IRDAI, that is the insurance regulator, has started the process of gathering views on GST on insurance. Insurers are likely to submit their views in a week. And Yash has picked up what perhaps they may submit. Yash, what are you picking up?
Well, Lata, all eyes now would be on the next GST Council meet. And of course, with respect to the changes that come about, hopefully, when it comes to the GST rates on two segments which are under consideration. One is health insurance, and the second one is the term life insurance segment. Now, what we've been given to understand from our sources is that the insurance regulator has started the process to gather industry views on what they feel that the right rate should be in terms of being able to pass on GST benefits to policyholders. Remember, the finance minister had also spoken about this thing. The process would be that all life insurance companies and health insurance companies are likely to submit their views with their respective councils, that is Life Insurance Council and General Insurance Council. The council submits the views with the regulator, that is IRDAI, and ultimately IRDAI would submit their views with finance ministry for them to consider those views. What are the demands? As far as health insurance sector is concerned, most health insurance companies want GST to be reduced to 12% with complete, I repeat, complete ITC or the input tax credit benefits. Currently, the GST on health insurance is at 18%. Some of the health insurers also want GST to be reduced to 0%, not exemption, but reduced to 0% or 5% with complete input tax benefits for senior citizens and up to 5 lakh rupees sum assured. Do remember, it is important to contextualize these numbers with the kind of spend which these companies make on procuring 100 rupees of premium for health insurance. That is 6 rupees per 100 rupees of premium. Life insurers also want GST to be reduced to 0% or 5% with complete ITC benefits.
Okay, got that, Yash. I'm deeply moved by your commitment to your beat at a time when everyone is looking for a break. And the entire newsroom is in a raucous mood. Admire your diligence and your ability to concentrate. Okay, we get that. The first preliminary suggestions coming from the insurance sector. They do not want zero tax because they want to set off the GST in the other levels. So input tax credit is something they want to take, and so no one's going for a zero tax, but definitely something way less than 18%. On that note, let's welcome Deepan Mehta of Elixir Equities to give us some analysis of the stock moves today. Well, Deepan, thank you very much. Good afternoon to you. Well, first up, I wanted to ask you about these e-commerce stocks. They're up and about today. Is there any juice left in them in terms of valuation? Zomato, Swiggy, Nykaa, all of them doing exceptionally well. Any in your buy list?
Yeah, Lata, good afternoon and thank you for having me on your show. No, I mean, I cannot, there's no specific news flow which has come whereby these stocks should rally the way they have. Except that I think that investors are narrowing to the fact that there are very few growth avenues left in the market. And these e-commerce stocks are where the growth is. And that's why I think a lot of money is being concentrated over there. Valuations have been put on the back burner as just more of a momentum trade taking place at this point of time. And if you look at the entire spectrum of all the various industries and what numbers they will portray for the December quarter, I think this is going to be the only bright spot where they may be able to declare very solid growth numbers, maybe not on profit front, but definitely in terms of revenues, and more importantly, in terms of other data points like subscribers, average order value, number of orders, and so many other various quantitative factors which we consider. But I'm not, I don't think there's any specific reason why they should all rally today. There's no news flow per se.
No news flow, but you're on buy mode on the stocks, right?
Yeah, that's because that's the only place where there is growth available just now.
Okay. Let's talk about Adani Enterprises, because that is the big move. We note that the Indigo A320 aircraft took off from Mumbai on Sunday. It spent an hour circling over close-by areas like Karzat Pain, carrying out technical assessment and approach maneuvers as a part of the validation flight process. And that went off very successfully. So now the street is hopeful that perhaps by May we should have the new airport at Navi Mumbai up and running. How much of a boost will that be for Adani Enterprises? Do you have any numbers with you?
No, sorry, you don't have any numbers. But look, this airport these are long gestation projects. And unlike the other airports which Adani has kind of acquired, this is one of the first airports which they're actually building out. And it takes a long time for such airports and such infrastructure ventures to break even. It may be a drag on the earnings also for many years as the volumes and the passenger traffic starts to pick up. And in terms of capex also is massive. So to an extent may depress even the return ratios, and the capital investment also is huge. So I don't think that, the fact that the New Bombay airport has a timeline for completion, that becomes a trigger point for buying Adani Enterprises. Sure, it's sentimentally positive. In the far into the future, it will start contributing to the profitability of the company per se. But I'm not sure in the next few quarters how it's going to really impact the earnings of Adani Enterprises.
Deepan, we're not done with asking you about even the Adani Group shares, which are up and about today. Again, I don't think there's any reason except that Adani Enterprises, there was a piece in Business Standard which said that they're expecting some very strong CAGR in revenues and EBITDA. I'll come to that in a bit. The stock that's really in the news is Ola Electric. Those shares are under pressure as the company's Chief Marketing Officer and Chief Technology Officer have resigned with immediate effect. Parikshit, our colleague from Delhi who tracks the auto sector closely, is with us with more details. Parikshit, please, what have you found out?
Well, a couple of reasons why the Ola stock is in the red. First of all, the company's market share has fallen to 18.9% in December. Remember, when it started this fiscal in April and also just ahead of that in March, it had a 55% market share. So that's a very sharp drop for Ola Electric in the last few months. Bajaj Auto and TVS, they are now leading the EV pecking order with a market share of 25% and 23% respectively. Ola Electric sales have dropped sharply to 12,996 in December. They had sold 29,000 scooters in November and 41,651 in October. So you can see the decline in sales for Ola Electric. Then you've got several high-level resignations. Anshul Khandelwal, the Chief Marketing Officer, Subhanil Chatterjee, the Chief Technology Officer, they have resigned citing personal reasons. And these are not the only two. You've got the Company Secretary, you've got the Chief People's Officer, the Deputy Vice President of Design, the Head of Planning and Strategy, the Head of Partnership and Corporate Affairs. These are just some of the few high-level resignations that have taken place this year. All in all, 500 people are likely to be laid off by the end of this year. We're told that the exercise of restructuring corporate efficiency is all going to be over by this month. But these high-level resignations, especially of the likes of Anshul Khandelwal, who had been with the company for the last 6 to 7 years, definitely raises concerns. Even Ola Krutrim head Ravi Jain had resigned earlier this year. What we're hearing is that the company has given these positions internally for people to manage. They will be filling relevant positions very soon. But falling sales, high-level resignations continue to raise concerns about the company.
Thank you very much, Parikshit. You know, that can be a very deterring for a company and for an investor when people in key positions resign. Three bazaar anchors take leave together and we are feeling a little overwhelmed. That is, I am, not Rima. But let me get those with us, sorry. Dipan is with us, sorry. Dipan into the conversation. Dipan, Ola Electric, does this fall make it a buy, or are you worried about the reasons why it's falling?
No, Lata, this fall is not a buying opportunity. And I'm not sure that Ola Electric has completely got its act in order. I do not see visibility when the company will start to make profits. And the way the market share keeps on fluctuating and the kind of competition building up, I'm very skeptical about the Ola Electric's business. They may prove us wrong. They may start to get the sales going and have solid volume growth and profitability in the immediate future. But I don't see that happening for the time being. And it's, I think, a business which is best avoided at this point of time. Let the competition settle down in the EV space, and then the winners will actually emerge. So for existing shareholders, it's a tough decision. But I would still go and press the sell button.
Oh. Dipan, what about Coforge? Now, Coforge has completed the acquisition of Cigniti. The share swap ratio was announced over the weekend. For 5 shares of Cigniti, you get 1 share of Coforge. So Cigniti share, stock price is down nearly 5%. But Coforge, after opening in the red, has now recovered, and it's had a good year, 54% rally to boast of. From here on, considering that it has a pretty good exposure to BFSI, etc., would you bet on Coforge? Because, when the acquisition took place initially, there were still some concerns when they acquired Cigniti.
No, Rima, actually, within the entire software space, there are only 4 or 5 companies which are growing at double-digit growth rates or like mid-teens type of growth rates, and Coforge is one of them. And no doubt the valuation is very expensive, but at the same time, the exposure of the IT industry within all the benchmark indices is very high. So investors who are benchmarking against these indices need to have exposure to software companies. And I would say it's better to go with the Coforge or the Persistent Systems, KPIT, rather than going with the TCSs and the Infosys and the HCL Tech. Because I feel that these companies, although they are trading at expensive valuation, may still deliver higher returns. just purely on account of the fact that they are growing in the mid-teens. And there are very few companies, mid-cap, large cap, nobody's growing in mid-teens, mid-cap, which are growing at mid-teens. So I think a lot of money is converging to the likes of Coforge and the other 2-3 companies which I named.
Okay. Well, one of the winners has been Gokuldas Exports. I would assume it's because of the falling rupee. But any export-related plays, Deepan?
Yeah, I think that's getting to be an interesting space. Gokuldas, of course, a bit on the expensive side, but recently we've seen a very good rally in Kitex garments. And the biggest overhang in Kitex garments is the conflict of interest because the promoters have another company in the similar business and they have not been able to sort out this kind of conflict of interest between the two companies. But by and large, I think the company is expanding aggressively. And last few quarters have been very impressive. And with what's happening in Bangladesh and China plus one strategy and rupee depreciation, at the same time, Kitex expanding its capacity significantly, and the kind of relationship which they have with a lot of their customers makes it a very interesting stock. And certainly it's on our watch list.
Okay. All right, Deepan, pleasure having you with us. Just one more day for the year to end. If we don't speak, then here's wishing you a brilliant 2025, Deepan. Okay, so that's the word from Deepan. We will have to take a break on that note. We're going to come back and we will have another expert joining us, Tridi Bhattacharya of Edelweiss Mutual Fund, to tell us how he sees 2025 panning out. Welcome back. There's a spot of green re-emerging in the markets in the mid-cap space, and that's making the advanced declines look far better. Maybe we should pull up the advanced declines graphs and you will get an idea that the last 10-15 minutes have been quite kind on the advanced declines front. As you can see, the wedge is narrowing. It was almost 3:1 in at least the BSE lines. And now it's more like less than 2:1.
Actually, IT has made a comeback. Remember, the IT index was in the red. Now, Nifty IT is up about 0.5%. So pull up that intraday chart. HCL Tech, Tech Mahindra now have a rally of close to about 2%. That's one. Even the FMCG index is marginally back in the green. And Pharma has gotten stronger. So clearly the market in the last 10 minutes has taken on a bit of a defensive tilt, with Pharma getting stronger, IT picking pace, and even FMCG back in the green. Maybe even for IT and Pharma, there is that rupee play.
Yeah, for what it is worth, the rupee started strong and has now weakened. So, it could be just someone playing the futures game. But the cynosure of the market have been the IPO listings. So many of them have listed with such tall premia. And that goes for the listings today as well. Of the three of them, Sensex Pharmaceuticals, Carraro India and Ventive Hospitality, a couple of them have listed with fairly decent gains. As you can see, Sensex in particular, a near 40% gain as we speak. And Ventive, not bad at all. That's a hospitality company, compares with all the hospitals. Let's tell you what these companies do and some details of the listing and the reception that they have got from investors. Vamakshi is here with the details.
Sensex Pharma is the first one that I'll be talking about. They had a stellar listing because they listed at 600 rupees per share, which is coming in at a 53% premium to their issue price. The company is a global research-driven pharma company. They focus on cardiovascular, diabetes, gastroenterology, and critical care injectables. The company manufactures products at its FDA-approved facilities, and they have a very significant presence in the markets like US, UK, as well as Canada. In addition to that, they also offer contract manufacturing services and is also vertically integrated by producing its own API. In addition to that, they're also expanding their presence in emerging markets. They're increasing their R&D capabilities, and they plan to drive growth ahead through acquisition and expansion of their manufacturing facilities. But when you look at the company's valuations, it seems like it is trading at a premium to peers like Ajanta Pharma, Gland Pharma at the issue price of 600 rupees per share. The price to earnings ratio stood at 58 times, which is much higher as compared to some of its peers. Ventive Hospitality is the other stock that listed today. The company listed at 716 rupees per share, which is coming in at an 11% premium. Keep in mind that this is the company is a hospitality asset owner with Marriott, Hilton, Minor and Atmosphere hotel brands. They have a portfolio which comprises of 11 operational hospitality assets, both in India and Maldives. They have total keys of somewhere around 2036 across luxury, upscale and upscale segments, and the plan is to increase it to 2,403 by FY28. In addition to that, they also have 3.4 MSF of commercial space that yields rent with 95.55% occupancy. Lastly, let's also focus in on Carraro India. They listed at 651 rupees per share, which is coming in at a discount to its issue of nearly 8% to its issue price. The company specializes in manufacturing of components ranging from small gears to complete tractor assemblies. They have 2 manufacturing plants in Pune. Some of its key customers include Mahindra, Action Construction Equipment, Volvo, among several others. But a weakness that that the company has a high dependence on very few customers. For top 10 customers accounting nearly 85% of its revenue. And the company very recently joined us, just a short while ago, and they say that they saw some slowdown due to elections, but they're not anticipating a very big recovery in the second half.
Thank you very much for that. Tridi Bhattacharya, President and CIO Equities of Edelweiss Mutual Fund, is on our show now. Tridi, thank you very much for joining in. What have you made of the volatility seen in the last, 3-4 months? Typically, whenever the markets used to fall in the first 9 months, or even for the last 2 years, the sell-offs were very shallow. It's just that this time, even the recovery has been very shallow. We're still down about 8-9% from our recent peak levels. So what is the call now as we enter into 2025, especially over the near term, and then maybe a 6-month call?
Good afternoon and season's greetings to you and all your viewers. I would say the difference this time is that I think we have we are probably seeing an earnings downgrades for the first time in the last 3 years, which is actually of some meaning overall. I mean, overall over the time period that you talked about 6 to 7 months, we've seen earnings downgrades to the tune of about 6 to 8%, depending on which segment you look at. And that's basically have kept the markets on the tender hooks. So in the first signpost that I would be looking out is, can the markets come out of this earnings downgrade cycle in Q3, which is the result season right in front of us? If you were to ask me my guess at this point in time, it will probably be not rather than yes. It'll be Q4 when, in my opinion, some better news might prevail. The second unknowable in front of the markets in January is as Trump takes over and his policies and what it does, what it means for the globe, emerging markets, India, and the likes. And that's clearly unknowable. We'll only come to know on Jan 20th or in and around once that comes through. So that's another catalyst or an event that market is grappling with, which is why you are seeing the volatility. And third, I think this budget that we will see end of Jan is the time when, for the first time, the Modi government will have to balance the capex versus the opex, or the capex versus the welfare measures. And I think the market would be watching out for that one. So quite a few events lined up in front of us. Not all of them are fairly straightforward, which is why you are seeing the volatility. And if I were to give you the near term, I think I would probably expect more volatility, at least for the first couple of months into the year. Then as we get more visibility, earnings story resumes, hopefully better days ahead. So that would be my assessment of the markets today.
Fair point. Thanks, Sudeep. Just hold on. One of the stock that's been intriguing us by its rally is Adani Enterprises. My colleague from CNBC Awaz, Yatin, is here to tell us what he has made. Yatin, one landing into the Navi Mumbai airport, is that the big reason?
Possibly one of the reasons, Lata, and if you look at Adani Airports, it's approximately 50% of the sum of part valuations for Adani Enterprises. If you look at, the airports business at Navi Mumbai, obviously it's an alternative to Mumbai's congested airport. And with operations probably starting in middle of April, analysts are now factoring in numbers from that particular asset. Now, if you look at Adani Enterprises, their airport business is right now operating about 8 airports in which they are, expanding airports or building new airports. They have a passenger market share of nearly 23%. And if you look at the Navi Mumbai airport, it will not only decongest the Mumbai airport, but help Adani achieve a significant amount of growth with respect to the passenger footfall and the amenities that they develop around the airport. If you look at brokerages, obviously most of them which cover Adani Enterprises see a 50% kind of a SOTP valuation contribution from the airport business, in which for the next 2 financial years they are expecting a 25% revenue CAGR.
Okay, thank you very much for all those details. Okay, if it's more than 50%, then I think that will bear watching. What I mean is the revenues from the airport division. Yatin, thank you very much for giving us a great perspective on what this one landing could mean. And my mind goes back to the Navi Mumbai airport, the Sahar airport. I remember that we had done an interview with AM Naik in the premises of the new airport. It was so huge. And it just looked like, okay, no congestion for at least, a few decades now. And in less than 1 decade, it's become so congested. That speaks to the amount of, the K-shaped recovery and the progress we are seeing in air traffic.
Indeed. But let's get back to our conversation with Pradeep. You spoke about earnings downgrades. Now, the view is that IT may still see earnings downgrades in Q3. But the question is, will that be the end of the earnings downgrades? And from, Q4, FY25 onwards, we will see a recovery because IT stocks have had a pretty good year, 23% year-to-date up move.
Indeed. And my sense is that Q3 is usually a furlough quarter. The expectations are fairly low. And hence, from a full year perspective, what is important is as we get into the new year, what they hear from their clients in terms of budget for calendar year 25. My sense is there also, before hearing the Trump's policies, there would be a bit of a caution. But if you look at recently Accenture's numbers, I think these caution is adequately built in the numbers. So relative to expectations, they might just about come okay, would be my thinking. Over the last 3 to 6 months, we've clearly added more to our positions in IT, and that has held us good. And hopefully, kind of, going forward, it sticks around. With regards to earnings upgrade next year, I am certainly more hopeful on IT because apart from the actually less so on currency depreciation, but more so on the better health of US corporates. As that stands to happen maybe in the back half of this year, IT spending could recover and Indian IT services companies as a beneficiary of the same could benefit, but that will come for the second half of the calendar year, not in the first half though. But yes, better days ahead for IT, hopefully in the second half of next fiscal year.
One theory, Trideep, could be that you should buy when the market is afraid. The market's now afraid of FMCG, of consumption. Mass consumption hasn't yet picked up, and especially after Godrej warned about a difficult Q3, the markets have read all kinds of fears into it. Would you buy mass consumption? That's consumer non-durables, FMCG.
So, great question. And I think last year, same time when I had a similar interview, we had talked about IT as a dark horse of calendar year 24. This year, I think for calendar year 25, consumption might be the dark horse for 25. Certainly, no great expectations and no great numbers to come out, particularly in the first 3 to 4 months of the year. But as the year progresses, I think 2 or 3 things will come to bear. One is the impact of better health of rural economy will start to take shape in the numbers of particularly some of the mass consumption names. Secondly, the luxury part of the economy, which was doing well anyway, might continue to do well going forward as well. And third, with regards to some of the discretionary items, I think overall, as inflation comes down a little bit, they might see a little bit better days in the world, along with possibly a bit of rate cuts. So all of this will probably be loaded more towards the second half of the fiscal year 26. But for that, a gradual accumulation during the first 6 months of the year isn't a bad place to be. But with clearly low expectations in the near term, I think consumption could be the dark horse of calendar year 25.
Okay. What about contra bets in the form of metals or specialty chemicals? They've had a rough year too. Would you bet on that?
Not. So my thinking there is that if we are kind of gradually for the next year or so getting into a stronger dollar regime, if we are looking at a slightly more fragile growth than earlier in the case of China and our other countries in the friendly neighborhood, then maybe metals and some of those globally exposed sectors might not do as well. So we certainly are not betting our hat on those names, on those sectors that we are talking about.
Okay, Trideep, it was a pleasure listening to your views on a bunch of sectors. Thank you very much indeed for joining us. And here's wishing a very happy 2025 to you and everyone in your family.
Likewise.
Thank you. Okay, with that, let's just one word on the markets. It's still a difficult day as far as the big indexes are concerned. The Sensex, Nifty and the Nifty Bank, all baskets of very big stocks are not doing well. So my sense is this smacks of FII selling even today. And the fact that the rupee, after starting strong, has once again weakened, indicates that perhaps today also we will get that 4-figure sell number from FPIs. Let's see. But the mid-caps are putting their chin up.
All right, let's get into a break on that note. As always, on the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few technical calls, PTSD calls, coming up right next.
welcome back. I'm sure all of you want to know what's happening behind these yo-yo movements in the market. We started off a little bit in the red, went on fairly brilliantly into the green, and then yo-yo back down to, a near 0.75% cut across all the big indexes. Some bit of green on the mid-caps. But what's behind all this? Your favorite segment, D-Street Chatter, is what we're entering into now. And Nimesh is with us. Nimesh, what are you picking up about this this zigzag movement in the market?
I know extremely like a sharp sell-off in the second half, but again the volumes are quite low, so the impact seems to be quite high because there is not much participation from the larger issues. That explains a big cut in the Nifty as well as in the Bank Nifty as well in the second half today. I guess selectively there is a bit of buying again in the PSU stocks. So some PSUs are well bid is what I understand from institutional investors in today's market. From a technical point of view, I guess Nifty seems to be in the range of the 1,000-point range between 23,300 on the downside and 24,300 on the upside. So for the January series, that's the quite range is what people are talking about that Nifty would range into. But clearly the volumes are on the lower side, so the moves are on the either side. But again, lack of institutional activity is what explains the kind of volatility you're seeing in the last couple of days.
As you said, right, the impact is so much more now. But what about stocks, Nimesh?
Well, so in terms of individual names, the first stock is Apollo Microsystems, a small stock. It was part of my chat a couple of days back as well. The volumes on the higher side, I understand some flows are back at HNI desk. A leading HNI investor is an active buyer as well is what I understand. And also the buzz I had highlighted earlier as well that the city is anticipating a large order win for the company very soon. So that is something to track in Apollo Microsystems. The second stock is Manappuram Finance. From the recent lows of 150, we've seen a sharp up move in that name as well. The flows have resumed from larger FIs in Manappuram Finance, and also the city is anticipating a corporate development very soon. For Manappuram, couple of triggers to watch out for. One, the potential approval from the regulators as far as Ashirwad MFI is concerned. That's an expectation. And two, a stake sale in the listed entity as well. So these are the few triggers to watch out in Manappuram Finance. And the last is IGL. I spoke about some bit of buying back in the gas names and PSU stocks. IGL stands out on back of very strong buying interest. So the flows are on the higher side. Expect high delivery volumes, and looks like the institutional interest is back in IGL at these levels. And remember, for IGL, 404 seems to be a big technical level as well to watch out for. Above 404, there is a big technical breakout, is what I understand in IGL.
Okay, thank you very much for that, Nimesh, for all the tidbits that you're picking up from the street. I really wish somebody would tell me what's happening in ITI. I mean, it's just, maybe if you can pick up a 3-month or a 6-month of ITI, it'll give you the idea of such wide zigzags you see in that stock. Today is the up day with a 15.5% gain. I mean, we have yet to find out why, but it's not unusual. It happens every now and then in ITI, this kind of a move. So a puzzling way in which that stock is moving with volumes. When it gains, it really gains with volumes. But let's see if our technical expert has other stocks to spot for us, especially for the buy today, sell tomorrow segment, or the sell today, buy tomorrow segment, a reverse trade. Rahul Sharma is here for that. Rahul, welcome once again. Okay, what is the BTST call today?
Yeah, so there are two ideas, one long and one on the short side. So first we'll discuss the shorting idea. So there is a fresh breakdown that is seen on the charts of Hindalco. Metals have been under pressure since last few trading sessions. And Hindalco has broken down below the 614 mark. I think the stock is headed towards 580 to 560 on the downside. So one can look to either buy at the money put options or go short into the stock with the stop loss placed at 620. Another stock which looks good on the long side is another one from the pharma space. So earlier we discussed Aurobindo Pharma. Another one that looks good is Divi's Labs. The stock has pulled off from a 15-20 day kind of a sluggish move. Strong volumes happening today both in cash and F&O segment. We believe that the stock is headed towards the 6200 plus mark, so can be bought at these levels for a BTST as well. And positionally also the stock looks good for a decent upside from these levels. Stop loss on this one will be placed at 6975. 5975.
Okay, thank you very much for all those ideas. And Rahul, have a great weekend yourself. Have a great year-end celebration. May 2025 be great for you. Okay, so that's what coming in from the BTST corner. It's important to tell you what the big boys are looking at in 2025. And we got quite a bit of a buy sell today from Chris Wood in his Greed and Fear report. He's speaking about his long India or long only portfolio for India and what he would go long on. Hormuz is here to tell us what are the key takeaways from that report. Hormuz.
You know, the news that came in earlier this morning was the fact that Chris Wood has turned bullish on HDFC Bank, reintroducing his investment in the Asia ex-Japan long-only portfolio and the India long-only portfolio, where he's going to increase his weightage in HDFC Bank. But what else is he betting on in his India long-only portfolio? If you trim it down sector-wise, you'd look at ICICI Bank, HDFC Bank, and also SBI. You know, for all the chatter we have had around HDFC Bank, we've completely ignored the fact that ICICI Bank is up 30% this year, and the fact and other as SBI as well has had a 25% plus return so far. The other financial stocks, if you take a look, the stocks like SBI Life, REC, PB Fintech, well, SBI Life and REC has had a quiet year, but PB Fintech has emerged as a winner this year, with almost 160% return so far. You go into the energy space, it's been a year of underperformance for the big boy Reliance Industries. Even for Coal India, it's been a not so positive year, but JSW Energy, a stock in news today, has done well through the year, up almost 60%. Now, real estate is a theme that Jefferies has been bullish on for quite a few years now, and it shows in the stock recommendations as well. As barring Aditya Birla Real Estate, most of the other names that in part of the India long-only portfolio have gained anywhere between 15 to 35%, be the likes of Godrej Properties or Macrotech. Infra and industrials is one segment where you've clubbed together. It's been a quiet year for stocks like GMR Airports and L&T, but Siemens, that has seen a bit of a dip, which has now become a part of the India long-only portfolio, has already surged 61% despite the recent correction that it has had. And some of the other holdings, of course, the two outperformers this year, Zomato is one of them, 120% surge this year, and Bharti Airtel as well, a 60% gain in 2024. That too form a part of Chris Wood's India long-only portfolio. Back to you guys.
Okay. Thank you, Hormuz. That's a very interesting set of details about how that portfolio performed. Yes, the big boys have been slackening this year, but I think I'm interested that the big boy that didn't do well for this long-only portfolio of Chris Wood and for many others, HDFC Bank, is now getting a look in from Chris Wood. We have another expert joining us. Anand Tandon is with us. And Anand, I'm going to start. Thank you. First, let me thank you for joining us, especially in a holiday-thinned time. Good to hear, good views. What did you make of this? Do you think it's time now to give a re-look at HDFC Bank and the banking space in general?
I think HDFC Bank certainly deserves a look. It has not performed very much except for the last few weeks. And, the fact is that because of the growth slowdown, that was somewhat anticipated. But at the same time, the underperformance has been somewhat steep. Given that we are now re-looking at growth coming back to some extent, and more importantly, the rest of the sector not being able to grow as much either, the relative underperformance will have turned around. And, the fact that from a stock market perspective, it has been dragging as well, will obviously position it for a growth from here on. So I would expect that the growth trajectory from here for HDFC relative to the rest of the sector will be slightly superior and will increase in the kind of profile that we are likely to see going forward. And in that context, the fact that it is relatively cheaper compared to both its historic earnings as well as, relative to the rest of the market makes it certainly one of the top picks at this stage.
Anand, hi, afternoon. We were chatting with Manish Sonthalia of MK, and he said one of the big themes to bet going into 2025 is the rupee depreciation. And therefore, he likes IT. I mean, not therefore, but he likes IT and pharma, or he puts the focus on IT and pharma on account of that. Would you concur?
Let's say the rupee has not depreciated for some time now, last couple of years, and therefore, it's a natural tendency to depreciate by 3-4% a year is likely to come through. Maybe it will happen all at one go. And therefore, you may find one sudden depreciation. But in my view, the major fact in the near term of the depreciation has been the fact that the US dollar has been appreciating against everything. And rupee is not the only currency it has appreciated against. It has appreciated against everything else. That is a bit of a distortion because to my mind, that cannot last for very long. There is no case that is there right now for saying that, the US dollar should remain very strong. In fact, if at all, the attempt should be from the US government that if they want to discourage imports, that they should also, weaken their currency a bit. So I think the best is already there for the most part in the price. Now, even the inflation differential or the interest rate differential, the interest rate differential actually has come down, so that we are negative for the rupee. But the inflation differential is, what it has always been. Net, my view is that the rupee may depreciate for the first half of the year a little bit more. But I would imagine that once the new government is in place, this euphoria about the US market being in a very sweet spot will likely evaporate, and you will see more realistic numbers coming through. And that will put some pressure on the dollar. So I don't expect to see any exceptional gains coming.
Okay. Thanks a lot for that, Anand. Just coming back to you in a minute, there is an announcement from Adani Enterprises that they are to exit the Adani Wilmar JV. They have signed an agreement with Wilmar International, and AEL is going to sell 13% in Adani Wilmar, and that's not for any other reason but to achieve that 75% minimum public shareholding. And Wilmar International has agreed to acquire that stake. In fact, it's agreed to acquire 31% held by AEL, that is Adani Enterprises, in Adani Wilmar. With this, AEL will fully exit Adani Wilmar, and Adani Enterprises nominee directors obviously also will step down. They have also agreed to a change of name of Adani Wilmar, because obviously Adani is moving out, and the proceeds of this sale will be, of course, utilized for Adani Enterprises' other infrastructure ventures. That's the announcement coming in from Adani Enterprises. I wonder what's the agreement with Lens Private Limited. Lens PTE also holds a stake in
is the
Adani.
wholly owned subsidiary of Wilmar International
Okay,
Limited.
so they hold through it.
Yeah. So basically, right now, the promoter holding of Adani Enterprises is 88%, which is Wilmar International has 44% and the Adani Group has 44%. So together you have 88%. They need to come down to 75% to comply with the public shareholding. So the Adani Group will completely exit by selling its 44% stake. Of that, 13% will be to come down to, the overall holding of 75%, and the balance 31% will be sold to Lens PTE, which is basically the Wilmar International Group. And therefore, now the company that you have eventually will be completely owned by Wilmar International, and the name will be changed. So this, coming down to 75% was expected, but the fact that Adani now is exiting Wilmar International too.
Yeah, I think it could be also that, you see yourself as an infrastructure company, and there's no point in perhaps getting into the one space which is not infrastructure for them, the FMCG space. It could be just that, or it could be other reasons we'll have to check out. After all, the group is always in need of money, considering the projects they are in. Anand, any thoughts on this transaction at all, or do you even have a view on Adani Wilmar, for instance?
But I don't have a view on it, but I think what you're saying is probably right. It's bang on, because this is a 4% operating margin business, and the group is in most of the other projects are fairly far more lucrative. So if you have to get out of something to consolidate and find some equity which you can put into the other businesses, this would be it. This is a fairly commoditized business, despite the attempts to brand it. So I think it's somewhat logical to exit this.
Okay, we'll slip into a short break on that note, but Anand, do stay on. Just counting down to the close of today's trading session, still down 150 points in the Nifty at the day's low.
Welcome back. The markets, as Rima has been telling you, have seen some bit of a recovery. The mid-caps are holding on to the green, but it is still about 2:1 in terms of the advanced decline ratio, or rather the decline advance ratio. We have been speaking with Anand Tandon. Anand, we did see a considerable shaving off of, prices for the Nifty, but mid-caps have held their own. If, as you venture into 2025, if you were given, some money to invest, what would your top picks be?
Well, I think the mid caps have performed very well over the last couple of years now, maybe a little more than that. So much so that their performance has perhaps outstripped, in terms of valuation, what the large cap is. If you were to expect that there may be some turbulence in the year going forward, I think you are better off perhaps both on a valuation as well as on a safety basis to be investing in large caps. Now, it doesn't mean that I'm advocating all shift out of small cap or all of it into large cap, but from an asset allocation perspective, I would argue that you should be now slightly more in large cap and slightly less in mid cap and small cap compared to what you would have been in over the last couple of years. So from the large cap, I think the traditional dogs of the Dow, to my mind, makes the best sense. Those stocks which have not performed for several years are likely to now cyclically move up. I mean, take consumption, for example. If the argument being made today is that you were likely to get rural consumption going up because of the efforts of the government, etc., then, a company like Hindustan Lever or a Dabur, etc., could be clear beneficiaries. HDFC, we've already spoken about, has been an underperformer, will likely do well. Reliance, after the time that they raised money, has not done too much at all, but they now have a fairly strong presence in retail, a strong presence in media. Telecom obviously now contributes more than half of their total profits. All of them have potential winners if they were to be broken up into multiple companies. So I would argue that the front line offers some more value than perhaps some of the smaller companies. That is not to say that they are cheap, but relative to the rest of the market and their own history, perhaps they are better positioned.
Okay. Anand, that's solid advice for those who are listening and waiting to see where to park their money as the new year dawns. Of course, you don't change your market preferences with the calendar, but appreciate your point that value at the moment probably lies with the big boys. Thank you very much and have a very good 2025 yourself. Okay, that's the word from market expert Anand Tandon. As we wind down to the last 1 minute of the market, the news is that the losses have been pretty severely cut. The Bank Nifty was trending at about 1% cut. It's now ending the day with a 0.5% cut. The Nifty and the Sensex also were at 0.75 thereabouts, now ending closer to a 0.5% cut. The mid caps, which were doing very well, are threatening to end in the red or absolutely in flat terrain. The best performing stock in the Nifty itself has been Adani Enterprises today, and we know that they've got a little bit of money now, having sold off their stake in Adani Wilmar. So, of course, landing of the first flight in the Navi Mumbai airport has also helped Adani Enterprises, at least sentimentally. Apollo Hospitals, Tech Mahindra, in fact, all the tech stocks, HCL Tech, have been doing well, with perhaps the Trump assurance of backing H-1B visa helping them. And then there's the odd IndusInd Bank, Shriram Finance doing well. But rest of the banking pack really is not done too well. Mid-caps, any standouts?
Well, JSW Energy managed to close up post the acquisition. Street likes the acquisition that they did, and it's at good valuations.